Expectations for a dovish Federal Reserve come the interest rate meeting from the US at the back end of this month has given a little bit of a lift to equity markets, the S&P 500 finding new ground above the 3,000 level. Let's catch up with Ron William now from RWA Advisory, who is joining us from our Singapore newsroom today. Ron, good to talk to you. I just really wanted to talk about what's happening on the S&P 500 at the moment, because clearly with what we've been talking about in the past has been something where we should be on edge about a potential down move for this index, but it hasn't yet happened. Explain what's going on.
Yes, so the trend has continued to be our friend, and we're in this two-year holding pattern, rising higher, and that's the regression bands that you can see there on the opening chart. Now, we're holding above the 12-month average, or the 52-week average just shown there on the chart. The upside targets are into 3,200, so for those who are looking for further upside, a tactical short-term profit would be around the 3,200 level. Although the one thing I would say is just keep in mind the risk side, which we'll look at a little bit later, is that much more greater. So it is good to have risk-averse tactics, trailing stops, and just be a little bit more aware of any fast reversals or loss of momentum in the coming weeks or months ahead.
Well, this has been something we've addressed before, isn't it? In fact, the further up the markets go, the bigger the risk. Explain more about the risk side of this trade.
Well, we're currently on the two-year mean, if going back to that regression band. But on the second slide, you can see there, green is the area that most people are gunning for, but red is actually what we need to be concerned about, and that's the growing asymmetric risk. So, as you correctly said, the higher we rise, the harder we fall. And it's often not taught in one-on-one technical analysis because we tend to focus on the trend being our friend, but that's only as the trend continues to be sustainable. And so, unsustainability is now actually upon us, particularly given the divergence that we're seeing across S&P small caps and actually the FANG stocks themselves. So on the third slide there, you can see the small cap stocks actually sideways on their -1 sigma, or towards the bottom part of that two-year channel. And then the FANG stocks, there's an index there on the slide just showing that the FANG stocks have been underperforming year to date. So actually, although the index is rising higher, the real strong generals in the military field that make up the S&P 500 are actually holding back, not pushing forward. So you are getting some large cap stocks pushing up the S&P 500. They're more defensive. It's the quality and maybe defensive names which are still holding up. And within the FANG complex, I think you still have Apple, Facebook, and one or others actually depreciating in value. So divergence across the board, small cap, but even within the large cap complex when we look at FANG.
I've said it's been more record highs for the S&P 500, of course, around the testimony from the Fed Chair, Jerome Powell, as we go into that interest rate meeting at the back end of the month. Explain some of the potential moves that we could have, the good, the bad and the ugly from where we've been, because it's really not been such a bad year so far.
Well, year to date, it has been positive, but we must remember the roadmap that has taken us from beginning to now. May was the sell in May setup that I was calling for some time, because that's the traditional negative seasonality, or the beginning of it. We did have a negative May. In fact, it was the second worst since the 1960s in terms of S&P 500 performance. But then immediately afterwards, we had a V-shaped recovery, which everyone, of course, knows. June was actually the best June since the Great Depression. So we have this elastic band, bifurcated market, two-way upswings down and up, and so a break in the seasonal pattern. But the most predictable pattern within the seasonal roadmap, let's not give up on it, is the August peak and autumn fall crash cycle. So September and October are the anniversary months for much higher volatility, and it really is up to the bulls and bears out there. You've got multiple roadmaps to look at. The good being 2017, where we actually just carried on higher into that Christmas year-end rally. The bad would be the actual average, where we just see below average or negative performance for the equity market. Or the ugly, which would be a rhyme or repeat of last year, which no matter how bullish you were, it surprised all and continued much lower. And on this point, just keep in mind that this could be one of those buy into the rumor, sell on the fact. So if and when the Fed actually does cut, as they've already suggested, that probably will be a time for profit taking, and maybe then the market might knee-jerk back into its seasonal trend.
Let's just bring it all together then and bring it back to where we started off, taking a look at the progress that we've seen for the S&P 500. Where are we expecting this to go in the immediate future?
So certainly short-term tactical upside. We're already at these record highs, so really exciting time to be having this interview, Jerry, to actually have this upbeat uptick on the S&P 500, but also global markets that are holding up. Obviously, we're also seeing yields come down, so that's offering fresh respite to the equity markets. But let's also, while we've got that 3,200 target in mind, let's also keep in mind the risk strategies that I mentioned, because the asymmetric risk is that much more greater on the downside. So anytime the market were to break below the old highs around 29.50, you can see there the probability distribution showing 27.50 as being a key level, and probably the big make or break level will be the 200-day moving average at around the same level. If we break below that, we could get a revisit of the V-shaped low around the 23.50 level. That's a worst case scenario, but just to be objective and focus on all probabilities, that would be the worst case risk going into year end.
Okay, Ron, look, thanks so much indeed for revisiting this story. And as we go into that interest rate decision at the back end of the month, interested to see where the markets then move on from that point. That was Ron William from RW Advisory in our Singapore newsroom.